Imagine two people graduating from college in the same year. They both get decent jobs. They both live in the same city. They both earn roughly the same salary. 10 years later, one of them is stressed about bills, worried about retirement, and wondering where all the money went. The other has a 6-figure investment portfolio, growing passive income, and enough financial breathing room to make choices without constantly checking their bank account. At first glance, it looks like one person simply got lucky. Maybe they had better opportunities. Maybe they earned more. Maybe they knew people in the right places. But when researchers and economists study wealth over long periods of time, they often find something surprising. The biggest difference isn't usually intelligence. It isn't education. And it isn't even income. The real difference is that one person followed a formula. Not a secret formula. Not a complicated Wall Street formula. A simple financial equation that quietly turns ordinary income into extraordinary wealth. Most people spend their lives focusing on the wrong part of that equation. And that's why they work harder every year without feeling financially free. Because the money formula the rich actually use isn't about making money. It's about what happens after the money arrives. And once you understand that formula, you'll never look at wealth the same way again. The first thing most people assume about wealthy individuals is that they must earn massive incomes. It's an understandable belief. After all, if someone owns a beautiful home, drives a nice car, and has a large investment portfolio, surely they must make far more money than everyone else. But the numbers tell a different story. Many high-income earners struggle financially, despite earning hundreds of thousands of dollars each year. At the same time, countless millionaires never earned celebrity incomes. Some were teachers. Some were engineers. Some were small business owners. Some worked ordinary jobs for decades. What separated them wasn't simply how much they earned. It was how they managed the gap between earning and spending. This is where the formula begins. Most people think wealth is built through income. The wealthy understand that wealth is built through retained income. That may sound like a small difference, but it changes everything. Imagine two people earning $100,000 per year. The first spends $95,000. The second spends $60,000. Both have the same income, but one has created a machine that can build wealth. The other has created a machine that consumes wealth. And over time, that gap becomes enormous. Behavioral finance researchers have spent decades studying why people struggle to save money. One reason appears again and again. Humans adapt incredibly quickly. Psychologists call this hedonic adaptation. When your income increases, your expectations increase right alongside it. The raise that felt exciting 6 months ago becomes normal. The bigger apartment becomes normal. The upgraded car becomes normal. The expensive subscriptions become normal. And before long, your lifestyle expands to absorb nearly every dollar you earn. This phenomenon is known as lifestyle inflation. It's one of the greatest wealth destroyers in modern society. Because every dollar spent today is not only a dollar gone, it's also a dollar that can no longer compound for years into the future. And that brings us to the second part of the formula. The wealthy don't just save. They invest. Many people mistakenly believe that investing is where wealth begins. In reality, investing is where wealth accelerates. Saving creates capital. Investing multiplies it. Without capital, there is nothing to multiply. Think of investing as planting seeds. You can't grow a forest without first gathering seeds. The more seeds you plant, the more trees eventually grow. This sounds obvious. Yet millions of people spend years searching for the perfect investment while neglecting the habit of consistently creating investable capital. The rich often approach this completely differently. Instead of obsessing over finding the next big opportunity, they focus on consistently feeding money into productive assets. Stocks, index funds, businesses, real estate, assets that have the potential to grow and generate income over time. Because the formula isn't about making one brilliant decision. It's about making hundreds of good decisions repeatedly. This is where most people underestimate the power of compounding. Albert Einstein is often credited with calling compound interest the eighth wonder of the world, although historians debate whether he actually said it. Regardless of who said it, the principle remains powerful. Compounding is what happens when your money begins earning money, and then those earnings begin earning money too. At first, the growth appears slow, almost disappointingly slow, which is why so many people quit before the magic happens. Imagine pushing a massive flywheel. The first push barely moves it. The second push doesn't seem much better. Neither does the third. But eventually, momentum takes over. What once required tremendous effort begins moving almost effortlessly. Compounding works the same way. The early years are often boring. The later years can be life-changing. And this leads to the third variable in the formula: time. If there's one advantage the wealthy consistently respect, it's time. Most people focus on maximizing returns. The wealthy often focus on maximizing time in the market because time allows compounding to perform its greatest work. Consider two investors. One starts investing at age 25. The other waits until age 35. Even if the second investor contributes more money every month, they may still struggle to catch up. Why? Because compounding rewards time more than effort. This is one reason wealthy individuals often begin investing long before they feel completely ready. They understand that waiting for perfect conditions can become extremely expensive. But there is another piece of the formula that rarely gets discussed: consistency. Everyone loves financial success stories. The entrepreneur who became a millionaire overnight. The investor who bought the perfect stock. The person who made a fortune from one opportunity. But those stories create a dangerous illusion. They make wealth appear dramatic. In reality, wealth is often painfully repetitive. Month after month, year after year, the same behaviors, the same habits, the same discipline. Research into long-term wealth creation repeatedly shows that consistency often beats brilliance. A person investing moderate amounts consistently for decades can outperform someone who constantly jumps between strategies, chasing higher returns. Because wealth rarely rewards excitement. It rewards endurance. This is why the rich formula isn't really a shortcut. It's a process. Income creates opportunity. Savings create capital. Investments create growth. Time creates compounding. Consistency creates results. And when those variables work together, something remarkable begins to happen. Money starts solving problems instead of creating them. At this point, you might notice something interesting. None of these variables require extraordinary talent. None require genius-level intelligence. None require predicting the stock market. None require becoming a billionaire entrepreneur. They are accessible to ordinary people, which raises an important question. If the formula is so simple, why don't more people follow it? The answer lies in human psychology. People naturally prioritize immediate rewards over future rewards. Behavioral economists call this present bias. A reward today feels more valuable than a larger reward tomorrow. That's why saving feels difficult. That's why investing feels slow. That's why consumption feels attractive. The challenge isn't understanding the formula. The challenge is consistently choosing long-term benefits over short-term gratification. The wealthy are not immune to these psychological forces. They simply build systems that reduce their influence. Automatic investing, automatic savings, spending plans, long-term financial goals. They don't rely entirely on motivation. They rely on systems, because motivation changes daily. Systems continue working whether you feel motivated or not. This may be the most overlooked lesson in personal finance. Wealth is often less about financial knowledge and more about financial behavior. Many people know what they should do. They simply struggle to do it consistently. The rich formula works because it transforms behavior into results. Not overnight, not in a month, not even in a year, but over decades. And that's where the final perspective shift happens. Most people think wealth is a destination, a certain net worth, a certain income, a certain lifestyle. But the truly wealthy often understand something deeper. Wealth is a process. It's the result of thousands of decisions made over long periods of time. Every dollar saved, every investment contribution, every unnecessary purchase avoided, every year spent allowing compounding to work. Each decision appears small in isolation, but together, they create an entirely different financial future. The money formula the rich actually use isn't hidden inside a hedge fund. It isn't locked behind an expensive course, and it isn't reserved for the ultra-wealthy. It's a simple equation that has existed for generations. Earn, keep, invest, wait, repeat. Most people spend their lives searching for a secret. The wealthy spend their lives following a system. And in the end, that may be the biggest financial lesson of all. Because wealth is rarely built by people who know the most. It's usually built by people who consistently do what matters most.